This is your LMAX exchange technical update for Tuesday, November 7th, 2017. Euro dollar. So the euro continues to consolidate since breaking that head and shoulders neckline several days back, and the focus and the pressure is still on the downside while the market holds at a minimum below recent highs, this consolidation high in the 1690 area. We could see additional declines on a break below 1575 that takes the market down towards that next measured move extension following the consolidation break, which would be somewhere in the 11460 area. At this point, again, it would take a break and close back above 1690 to take the immediate pressure off the downside, though this wouldn't force a shift in the structure, and only ultimately back above the right shoulder from several days back, that was back on the 12th of October at 118.80, would compromise the current downside pressure and suggest the market is ready for a bullish resumption and a resumption of this firm uptrend that we've seen thus far in 2017. Sterling dollar. So cable continues to adhere to this choppy consolidation. The market has yet to break above or below that 33.38 or 30.27 level that had defined this choppy range on the top and downside over the past several sessions. A break on either end would be required for clear directional insight, though medium term the market favors the top side following a breakout earlier this year above 127.75. Dollar yen. So dollar yen is continuing to adhere to this multi-week range that we've seen roughly, with rallies capped up into the 114, 115 area and the dips supported down towards the 108 area. And so this latest topside failure is suggesting that the market could be poised to roll over again. A break back below some recent support around 1295 would strengthen this outlook. Euro Swiss. So Euro Swiss has come under a little bit of pressure since topping out at a 2017 high the other week at 1713. The focus here continues to be on the top side though, since this market broke out in 2017 above 110 and 112, some key resistance levels, and this now opens the door for a move up towards that psychological barrier that had been in place, that major floor going back to January of 2015 at 120. So any setbacks now that we do see should be very well supported ahead of 112. Aussie dollar. So Aussie has been consolidating its latest round of declines. The market overall remains pressured to the downside right now. If we do see a rally, it should be very well capped ahead of 79, and only back above that level would force a shift in the structure and take the pressure off the downside. Otherwise, look for a lower top and a continuation of declines down towards that next measured move in the 75s. Dollar CAD. So dollar CAD has seen a nice little pullback after rallying up to fresh multi-week highs. The market had been in an intense downtrend in 2017, breaking down to just shy of 120 before putting in this correction. The correction though does still look to have some legs here, and so if we do see setbacks over the coming sessions, look for them to be supported into this previous resistance turn support area in the 126 area ahead of a next upside extension back above the recent highs and through the psychological barrier at 130. Ultimately here, only back below 124 would put the pressure back on the downside. Kiwi dollar. The New Zealand dollar has been under pressure, breaking down to match its 2017 low from back in May at 68.18 ahead of this latest minor bounce. There is room here for a little bit more of a correction higher, though ultimately rally should now be very well capped ahead of 71 in favor of a continuation of declines. Only back above 72 would force a shift in the structure. SPX 500. The S&P 500 continues its push to record highs, with the market now considering a meaningful push above 2600, and although those weekly and monthly studies are highly extended, the market would need to break back down below 2544 to take the immediate pressure off the top side. Gold. So gold has been very supported on dips over the past several months, and so this latest round of setbacks into the 1260 area are expected to once again be supported in favor of a higher low here and continuation of gains back towards and through the current 2017 high from September at 1357, and then exposing a retest and break of the 2016 peak at 1375 further up. Back below 1260 would delay the constructive outlook, but it wouldn't negate it, and we'd only see a negation of that on a breakback below 1200. So ultimately, while above 1200, the structure is quite constructive right now.